Hello and welcome to this webinar on leases. We're calling it Don't Get Lost in Leases. I'm pleased to meet you. My name is Casey. I shall be taking you through the next call it 2.5 to 3 hours of this session. It was meant to be a live session, but obviously due to the current situation, we are not able to deliver it in a live setting, and therefore we are doing it over this. We're doing it online. We hope that the experience shall still be the same. We hope that you shall still learn and you shall still be able to take in the concepts. And if you have any questions, we hope that you shall be in a position to put them through, type them through. I'll be happy to respond. I'm logged on as you watch this, and you don't have to wait for question time. You can just ask questions as we go along to make sure that you actually don't get lost in leases as we go along. So what's the background? I think by now you are probably well versed with the background to this standard. It has been a long time coming. It's a joint project with the FASB, that's FASB, that's the American Federal Accounting Standards Board. For the rest of the world, we have mainly the International Accounting Standards Board. So they worked on a project together, and they agreed that we should try and have a single model, although there are some differences on recognition and presentation. The concepts are largely the same in terms of how we account for leases, in how they account for leases in America, and how now the rest of the world, by adopting IFRS 16, by creating and adopting IFRS 16, is accounting for it, largely with respect to how we account for operating leases from a lessee perspective, which is the big change in IFRS 16. So why did they issue the standard, other than the fact that they were looking at aligning with the Federal Accounting Standards Board? There was a discrepancy, or rather there was some, you can call it conceptual differences between the conceptual framework and how we accounted for leases, because the conceptual framework conceptually talked about what an asset is and what a liability is, and the way we're accounting for operating leases, the initial contract that you entered into as an operating lessee of, say, or a building, conceptually that gives you certain rights, and they lead to economic benefit, and therefore and that economic benefit is mostly beyond 12 months, and so that suggests that there is an asset that's conceptually created, and for a long time there's been resistance to putting that asset and that liability on the balance sheet, and now this is the reason why we have issued the standard. Other than aligning it to what the Americans are doing, it's to ensure that conceptually we have consistency in application of the conceptual framework. This is the navigation that we are going to undertake. We are going to start with looking at the scope. After we look at the scope, within the scope, we're going to look at what are the exemptions, what are the areas that are excluded from this standard. Then we shall look at what exactly is a lease. That's very important, because you shall see as we go along, there are certain situations where you've probably thought that there is a lease, but in truth, there isn't a lease. And that is because the definition has been refined. There's been clearer guidance that's been provided as to what exactly a lease is. Then we'll start by looking at, from the lessee's perspective, as I said, that's a big change in IFRS 16. We shall look at initial measurement. That is to look at the asset side of things, and also to look at the liability side of things, to take note of how we establish what the asset is and what the liability is, and how we transition to both those items. And then we shall look at subsequent measurement, how the asset and the liability are accounted for once they've been put on the balance sheet in subsequent periods. And then a bit of lessor accounting. That's the one area that's not really changed from the way we are accounting for it currently under IAS 17. And finally, we shall look at our presentation and disclosure and the effective date of IFRS 16, which I guess you're aware of by now.
Okay, so let's look at the scope of the standard. Let's see what is in and what is out. IFRS 16 applies to all leases except leases to explore for use of minerals, oil, natural gas, and similar non-regenerative resources. So this is basically because the oil and gas space, when they were looking at this standard, is an area, particularly in areas like Canada, that who apply IFRS. They've been very protective. They've got a very big oil and gas industry, and some of these rules, there was some resistance to it. So it's more of a political exclusion, so to speak, and also by nature, in truth, non-regenerative resources are quite different from other leases that we have. And so if you lease a property for purposes of the extraction of non-regenerative resources, it could be diamonds, platinum, and so on, then that is excluded from the standard. But we need to be careful. There's instances where leases are just subsurface rights, so it's not exactly for the extraction, but it's a subsurface of a mining area, which the lessee can use, to put up offices and so on, in which case then they would still be under the standard. And we have an example of that later on in this webinar. Contracts within the scope of IFRIC 12, service concession arrangements. What are service concession arrangements? In South Africa, we have a clear example that's been in the news for the longest time, and that's an arrangement such as the e-tolls, where a private party enters into an arrangement with a public entity. So it's usually a public-private partnership where they say that we shall toll this road, we shall improve this road, we shall expand the highway as they did, and instead of you as the government paying us, we shall then be able to have a concession where for a period of 10 years, 15 years, 20 years, we shall put up tolls, and the users of the roads that we've expanded are the ones who are going to pay us. So that obviously has features of a lease, because the road is public property. It's property that's owned by the government. The government is giving a 10-year, 15-year, 20-year entering into a 10-year, 15-year, or 20-year arrangement, whatever the period might be, arrangement with the service concessionaire, if you'd like to call them that. But that is excluded because IFRIC 12 has got some special requirements that have been applied within that standard that looks at how we should account for it. From the perspective of lessor, there's licenses of intellectual property within the scope of IFRIC 15. Obviously, if I'm the lessor, it means that I'm the one who's earning revenue. IFRS 15 has got some dedicated guidance and requirements that look at how, if you're licensing intellectual property within that scope, if you know IFRS 15 well, you've probably applied it by now. You would know of such terms as the right to use versus the right to access in the case of software, where it's really discussed to talk about whether it's over time or at a point in time. So in instances where software providers, for instance, give people the right to access their intellectual property for a period of time. It could easily also be viewed in the context of a lease, but what the scope is saying is that that should be excluded, and you go to IFRS 15 for those type of leases if you are the lessor. Back to the lessee's perspective, leases of biological assets, those are assets within IAS 41. That's living things, plants, animals. There might be instances where, you go and you lease coffee trees, a farm that has got, I don't know, a good number of coffee trees, which are also accounted for as bearer plants in IAS 16. Those are excluded if they are biological assets. Also, rights held under licensing arrangements under IAS 38, where people pay royalties for films, videos, plays, patents, manuscripts, and copyright and such like items. They're excluded from IFRS 16. So there are certain items that are within the scope of IFRS 16, but for one reason or another are considered exemptions from the requirements of IFRS 16. So they may not be leases of, service concession arrangements or IAS 38 intangible assets under copyrights, manuscripts, as we've looked at, may not be oil and gas, and may not be those things that are exclusively excluded from the scope. They are items that are included in the scope, but despite being part of the scope of IFRS 16, the standard setters have said they're exempted from the application of the requirements, particularly from the perspective of you being a lessee if you have an operating lease. One exemption is short-term leases. That's standard has an exemption for short-term leases. What does that mean? If you have a lease that the lease term is less than 12 months, then you are not required to apply the standards, the requirement to put an asset and a liability on the balance sheet. You have an exemption. This is an optional exemption. It does not mean that if it's less than 12 months, then you're not allowed to do so. If you choose to, you can take up the exemption, and therefore you continue to account for it the way we accounted for it previously under IAS 17, and that's by just expensing the lease payments as you go along. But what is the lease term? The lease term is defined as the non-cancelable period plus any extensions where the lessee is reasonably certain to exercise that option, plus any period that covered by an option to terminate where it is reasonably certain the lessee will not terminate the lease. So if, let's say, the lease has an extension at your own option, you're told it's a 5-year lease, but you have the option to extend for a further 5 years, and you quite like the place, it's really working for you as the lessee, then instead of accounting for this lease over a 5-year period, it would be accounted for over a 10-year period because you're saying that you'll exercise the option. Similarly, you may have no penalty for terminating the lease after 3 years. You ask yourself the question, am I likely to terminate the lease after 3 years? If the answer is yes, then you don't account for this lease over the lease term of 5 years. You instead apply the 3-year period because that's the reasonable period, because you're reasonably certain to terminate. If you're reasonably certain not to terminate, then it means we account for it for the remaining period past the termination date. Again, on short-term leases, the exemption for 12 months. This is for if you are lessee who wants to utilize the short-term option. This lease may not include a purchase option. So if it's a lease that's got 8 months, 10 months, less than 12 months, but there's an option to purchase, then you are not allowed to apply this exemption. Again, you must also apply it consistently for each class of underlying leased assets. So if you said that you're going to be, you've got photocopiers that are within this standard, or printers, there are certain high value items like printers, certain printers which are high value, or if let's say you've got a bunch of servers which are quite expensive and they're under this particular exemption, they are being listed for 12 months. If you choose that you're going to, for that class of assets, you say for our IT items, we are taking up the short-term leases, then it means you applied consistently to all those classes of assets if it's IT equipment, for instance. If the lease is modified or there's a change in the lease term, the lease is considered a new lease. That's in terms of a short-term lease exemption. So you didn't know that you are going to change the lease term. It's for 12 months. It was never there in the original contract. You didn't expect that you are going to renew it. Then there's a modification. Maybe you had said the lease had an escalation period of 10%. You thought that 10% is too high, and therefore you knew I'm going to, when this lease runs out after 12 months, I'm going to end the lease. And then the landlord considers the economic situation and he comes to you and says, look, let's make a deal. Instead of charging you 10%, I'm going to charge you 5%. Meanwhile, you've accounted for the lease as a short-term lease. You've been expensing it as you go along. At that point, then, what we are saying in terms of the standard is that it's a kind of like a change in estimate in terms of IAS 8. You know the difference between an error and a change in estimate. Estimates are accounted for prospectively. So it's a similar treatment here where we say, okay, fine, this is new information that has come to light. We've modified it, and therefore we're treating it as a new lease, and we're going to account for it going forward as a new lease. Low value assets are another exemption that you have. The standard setters have been quite reasonable here. As you know, your list of items such as your cell phone, some of your laptops, all those are actually leases in terms of IFRS 16. They meet the definition. They are not excluded from the scope. But you may know that, you know, in the context, especially for big companies, items such as cell phones, items such as laptops, maybe items that you can say are low value items. Being low value assets, they are assets where the lessee can benefit from use on its own or together with other resources readily available to it, and an asset that is not highly interdependent on or highly interrelated with other assets. So we can't take a server, for instance, and say, okay, fine, certain parts of this server are low value assets, so we are considering them differently and saying that we're taking up the exemption. You can't do that. You need to look at it. It's highly interdependent. If it's one server, highly interrelated, then we can say that this item is highly dependent. So we have to look at the server in its entirety and ask ourselves the question as to whether it is a low value item. Again, how do we determine what a low value item is? The factors in making the assessment as low value, the assessment is based on value of new asset, regardless of its age. So we don't look at, even if you were to lease a second-hand item, you don't look at whether or not the second-hand item at the point that you lease it to say, okay, fine, this is a low value item. Say you lease a vehicle and you say, oh no, this vehicle, we've leased it when it was already 4 years old, so we think the value of the vehicle at this age is this much. You're supposed to look at the value when it was a new asset, and if that value is a high value item, then you can't use the exemption. It applies regardless of the materiality of the item to the lessee, so it's not a question of saying that, oh, we are going to look at it from the perspective of our company. We have a pretty big company, and therefore, given the size of our company, we are going to say that all vehicles, leases of vehicles, are low value items. So it's not a matter of materiality here. It's a matter of saying, is it an item that's low value? Is there a general consensus as to this item being a low value item, or is there not? So it gives standard setters, or it gives preparers a bit of a headache in terms of determining what I'm going to treat as a low value item and what I won't. There is a number that is in the basis of conclusions of $5,000. You're not obliged to use that number because basis of conclusions is not standard, it's not application guidance, it's not an illustrative example, but it is kind of a guide of a number that they were thinking when they crafted this idea of a low value item. So $5,000, what is that? And our ever escalating rand at the moment, touching on 20 odd we're talking about 100,000 rand. Items around that region or below would probably be considered a low value item, but as I said, this is an area of judgment for management. Entity-specific inputs are also not relevant to classification as low value. All entities should come to the same answer on assets in this category. As I said, general consensus is what we are looking at. And it's applied on a lease-by-lease basis. So it's a lease-by-lease basis, but remember that we need to have some sort of consistency in the application with regards to our different classes of assets. I've already mentioned this. It's not mentioned in the standard what the amount is. So it's an unknown. We don't know what the number is. The basis of conclusions, as I said, refers to a 5,000 US dollars amount as the amount that they consider any amount lower than that to be a low value item. Examples are given of cell phones, computers, furniture, tablets, and so on. Accounting under the exemption, you need to keep it simple. Expense the lease on a straight line basis, so you still required to treat to smooth the lease. As I said earlier, if you take any of the exemptions, the short-term one or treating an item as a low value item, it's accounted for as the way it has been accounted previously under IAS 17. So you expense the item over the lease term. So in other words, you apply the current accounting that we are doing under IAS 17. So here are some examples. It's time to think. Which of the following would you say in the services sector would be considered low value item? Would you say office buildings are low value items? How about office equipment, furniture, photocopiers, a delivery van, IT equipment used by staff members such as laptops, cell phones, and tablets? We've already looked at that as an example. Servers. So what would say office buildings? Probably not a low value item. Office equipment, I would say it depends on the equipment. So there are some printers which I'd say are more expensive than say 100,000 rand, or there is some equipment that is less. Some printers that are cheaper, some printers that are more expensive. Furniture, likely that it's a low value item if considered individually. Although some of these boardroom tables that I've seen in some of your offices are quite expensive, so you may not be able to consider it if it's on a lease to be a low value item. Photocopiers, same story, it depends. Delivery van, definitely not a low value item. Generally, motor vehicles are not considered low value items. Perhaps if you've got those, I don't know, Bajaj motorcycles, maybe those would be considered low value items, the cheaper brands. But generally motor vehicles, no. IT equipment, we've already mentioned, classic example of a low value item. A server, most servers, if you ask your IT guys, are quite expensive pieces of equipment, definitely more than 100,000 rand, and therefore I would consider them a low value item if we are using the 5,000 US dollars as the basis of establishing what a low value item is. So what is a lease? A contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. That's the definition. And there's a number of areas that you need to underline there. First of all, I need to control the use of, and then the big difference that has come through with this standard is the word identified asset. Asset needs to be identified. We need to have time and we need to have consideration. The standard looks at control as the right to obtain substantially all of the economic benefits from use of the asset and the right to direct the use of the asset. The assessment is made at inception and is only reassessed if the terms of the contract are changed. So there's a decision tree here that we are going to encounter and we're going to look at as we go along. First question I've already mentioned, we need to say, is there an identified asset? Yes or no? And we're going to look at what identification means. That's the first step that we look at. If we say no, we're already saying it's not a lease, and we stop we immediately begin treating it as we would treat any other item of expense, expense as per the payments that we make throughout the contract. So what is an identified asset? An asset may be identified in two ways. One, it can be explicitly identified. That's to say, we are going to give you a Porsche, lucky you, to lease for a period of 3 years. It's a 91T brand model. The registration is ND1342. So it's clearly, explicitly specified in the contract. But it could also be implicitly identified. Implicitly identified means it's not written out on the contract, but it's clearly shown to you the particular item that is going to be the subject of the lease. An example is the contract says we're going to give you a packaging machine model X876. The machine that we supply to you is the asset that you're going to be able to use for the next 2 years. So the day that the guys arrive and they deliver that machine, you know that that machine that they've given you is the one that you're going to have for 2 years. So it's not written in the contract, but it's implicitly identified at the time of making the item available to the lessee. Now, what if the supplier can substitute the asset? An asset is not identified if the supplier has a substantive right to substitute the asset throughout the period. Substantive means the supplier has the practical ability to substitute the asset, and the customer cannot stop this happening, and these assets are readily available to the supplier. The supplier would benefit economically from the substitution. I like to look at the example of a hotel. So you're given a hotel room. First of all, let's ask the question, is a hotel room a lease? Well, the first question is, do you have an identified asset? When you go on booking.com or hotel.com and you book the hotel room, there's no identified asset. It's not explicitly stated at that point. But when you walk up to the reception and you go and you say, I've booked a 2-week stay or a 3-week stay, if you're lucky to say that I'm spending my lockdown in a hotel for a full 3 weeks, lucky you, rich man. You go there and at the counter they give you the keys and they tell you, welcome sir, here are the keys to our presidential suite, situated on the 5th floor, room 560. Now it's been implicitly identified. Now if the contract says that you can at any point, the hotel can substitute, they can move you from the presidential suite to a different suite at any point. So if someone important flies in and they need the presidential suite, then during your 21-day stay they tell you, hey, you need to move from this room and go to a different room, which obviously will benefit the hotel because they've already taken your money and they're moving you to a different suite and they're giving the presidential suite to someone else. That means, therefore, you do not have an identified asset because there is no guarantee that you can benefit from that identified asset. The supplier can make the switch at any point quite easily, and it would be for their benefit. So that's a clear example of a situation where you would not have an identified asset. However, we need to look at the substantive nature in greater detail. So what does substantive mean? Substantive is determined at inception based on facts and circumstances available at that date. They do not include future events that are not likely to occur. So if it says, oh, in the case of new technology coming up, so they've given you a piece of IT equipment, for instance, and they say if there's new advanced technology, then they're going to substitute the asset, and that's not likely to happen, then it doesn't count as substantive. Substantive substitution does not exist where the asset is substituted in need of repairs or broken. So in the case of our guy in the presidential suite, if the contract says, oh, if there is anything that's not to your satisfaction, the aircon is not working and so on, I have the right to move you to a different room so that I can fix it and bring you back. Same thing with a laptop, to say I can come and take the laptop, I'll replace it with a laptop that's exactly the same as the one that you have, and as a result of that, I can be able to fix your laptop and then I'll give it back to you once it's ready. That is for repairs or breakage. We are not saying that the landlord has or rather the lessor has a substantive right of substitution. So if you can't determine whether a right is substantive or not, then we presume that it is not. Can you lease a portion of an asset? Definitely you can, provided it can be considered as physically distinct. So in the case of us saying that, I don't know, there's someone leasing a building 5 floors and they realize that they do not need more than 3 floors, but they've already entered into the lease, then you can come and you can lease the physically distinct 2 floors of the building. That applies to any asset that can, if you can be able to say I am leasing a physically distinct part of the asset, then we can say that you can lease a portion of the asset in terms of IFRS 16. So let's think. Starcom leases 10 times 1 gig fiber lines in the Mtunzini Marseille undersea cable numbered 101 to 110. So that's 10 gigs coming out of those particular sea cables number 101 to 110. Telnet leases 10 gig, similar amount, capacity from the Mtunzini Marseille undersea cable provider. Should these be treated the same? Well, the question we're asking here is, are these two both leases? Well, the answer is no, because the first one we've explicitly identified 101 to 110 are yours for you to use those fiber lines. They'll give you 10 times 1 gig. In the second one, we don't tell you which identified assets are going to be used. Yes, we are going to give you the same amount of capacity, but the lessor has the substantive right to substitute. If he started off with 101 to 110 and for some reason he wants to change 108 and 109, he can then switch those to 111 and 112, in which case you can't say that the assets I'm leasing are 101 to 110, because the contract just tells you you'll get 10 gig, don't worry how I'm going to give them to you. Moving on, does the customer have the right to obtain substantially all of the economic benefits from use of the asset throughout the period? Well, what are economic benefits? The customer is required to have rights to substantially all of the economic benefit from use of an asset throughout the period. The benefits include the exclusive use of the asset, subleasing you can sublease the asset, or get the primary and byproduct cash flows that come out of the asset. That is what then makes it having substantially all of the economic benefit from use of an asset. It must be assessed within the scope of the customer's rights. A customer specifying a car may only travel 10,000 kilometers per annum must be assessed within those parameters to see, okay, are you going to get substantially all of the benefit? So you ask yourself the question of, a vehicle, what on average is the kilometers per annum that a vehicle would give you? Is 10,000 substantially all, or is it not? So in that case, if we are saying vehicles, I don't know what the in general how far you drive. A lady who just, or a man who just drops his children at work and comes back home, and that goes to the shops, comes back, probably can do 10,000 as the normal kilometers for a year, whereas someone who drives lives in outside the city and has to drive into the city every single day would easily exceed that probably even do double that. So we need to assess it within the parameters to ask ourselves, essentially, is it substantially all of the economic benefits from the use of an asset? So if we are saying after 10,000, that's in month 7, you give it and someone else goes and uses it for the next 5 months, we can't really say we use substantially all of the economic benefit of this asset. Next, we ask the question, does the customer, the supplier, or neither party have the right to direct how and for what purpose of the asset is used throughout the period? So remember, for the first two questions, if your answers are yes is when we proceed to this question. If the answers are no, then we do not have a lease. So here there's 3 branches. It could be the customer, who has the right to direct how and for what purpose the asset is used, or it could be the supplier, or it could be neither party. How does neither party happen? At the beginning of the contract, we specify how the asset is going to be used and for what purpose, and neither of us can be able to change it. Let's carry on and we can discuss this in greater detail in the next coming slides. Directing the asset. So examples of who has a decision-making rights include changing the type of output produced. Who decides the type of output that will be produced? So if you have a container, who can decide I'm changing it to, I won't use it for transport, I'll use it for storage. I'll just park it at the corner of our premises and we'll store stuff in there, or we can take it and use it and put it on top of a big truck and we'll be using it for transport. Who can change when output is produced? So if you're leasing an item like, a power producing item, can you turn the machine on and off whenever you want? Is it a forklift that you decide I'll put it on when I feel like? I can put it off and pack it when I feel like. Who has the power to direct when the output is produced? Who has the power to determine where it's produced? If I lease a truck and the truck, basically I can decide I'm going to use the truck to transport from here to Bloemfontein, or I'll use the truck to transport from here to Witbank. It's my choice what destination I'm going to choose. Then we're saying, there's a level of being able to direct the asset. If that is controlled, then we have to ask ourselves the question, is it really us who has the right to direct it, or is it being determined by the supplier? And then the quantity of output obviously is a key item. You're leasing a photocopier. Can you determine how many copies you want to make, or is there a control on that? You can elect to cease operations, or you can elect to increase output depending on how you feel you want to use the item. So those are key questions: the type, when, where, and quantity. And we have another example. There's been some recent pronouncements from the IASB in this regard that we're going to look at further along. If it is a supplier, then immediately we say it's not a lease. If it's a customer, we say then it is a lease. Then we also have to then consider if it's neither, if it's prescribed already in the contract to say that in some instances it's a customer. If it said in the contract, neither the supplier nor the customer, once we set up this thing, is going to direct how it's used. So it's operating on autopilot. Then we'll have further considerations to make. But just understand that if it's a customer in this case, it is a lease. If it's not the customer, then it's not a lease. If it's a supplier, then it's not a lease. If it's neither, let's look at it in the upcoming slide. If neither party has the right to direct, then decisions about how an asset operates can be predetermined by way it is designed or via a contract. If the how and for what purpose are predefined, then the contract is an operating lease only if the customer has the right to operate the asset without the supplier having the right to change the operating decision. So we could have said that a vehicle shall be operating only the route between Johannesburg and Bloemfontein. In other words, then it's preset in the contract, and neither of us is allowed to change during the period. That's the route that we're going to apply. But if I have the right to operate the asset without the supplier having the right to change the operating instructions, in other words, I can drive it between those routes without the supplier coming in and changing the instructions as I go along, then I have the right to direct the asset. And in that case, then we say that we do have a lease. Now, what if the customer designed the asset in a way that predetermined how it will be used? If the customer designed the asset in a way of how and for what purpose it will be used is in their control, then we end there. We say that it is a lease because you pre-designed it, and as you can tell now, the more power that leans towards the customer having a power to direct the asset, get substantially economic benefit from it, we end up with the conclusion that the item is a lease. So it's time to think. Commodity trading enters into a contract with RT Logistics, a trucking company, for the transportation of grain from Beira to Lilongwe, and tea on the backhaul to Beira. Trucks are to be used as specified in the contract, so they're identified in the contract, and the supplier does not have the rights to substitute those for alternative trucks. So key element is identification, it's ticked. The contract specifies the goods to be transported, the date of pickup and delivery. RT, that's the supplier, will not be able to transport any other goods during the currency of this contract. RT Logistics operates and maintains the trucks. Commodity trading is prohibited from hiring another trucking company or operating the trucks during the term of the lease. Does the contract contain a lease? So remember the steps. First, we ask ourselves, is there an identification of trucks? So the trucks are identified, they are specified in the contract. Then we have to ask, who has the right to control the trucks during the use of the assets? It seems we have the right to control the use of the assets during the period because during the currency of the contract, we are the ones who are going to get substantially all of the economic benefit. But the question of who can direct for and what purpose the truck is used, and whether or not we can change it, can we direct it? That's where we hit a hurdle, and that's where we may say that we do not have a lease because it seems to be predetermined. It shall carry grain going to Beira and come back with tea. And who decides when who has those operating instructions? The contract says that the date of pickup and delivery are specified in the contract. So we are saying this is not really a lease of these assets. This is more of a transport type of contract where the RT Logistics is giving us a transport service rather than us being able to say, this is my asset, I make decisions about how I'm going to use the asset. So as I've said, the contract does not contain a lease. Yes, the identified assets, we tick that. Yes, the customer has the right to control the use of trucks during the period and obtain substantially all of the benefit during the period, but the customer does not have the right to control, as they can't direct how and for what purpose the trucks is used. Remember the questions we're talking about, the whens, the wheres, the quantity, and the what. The what is determined already. Where it's going is determined, what times it's going when it's determined. So we are prevented from that, and in that case we can't say that because this is already predetermined and we don't have the right to operate the asset, then we conclude that there is no lease. Okay, let's change it up a bit. So the same company enters into a contract with RT Logistics for the use of 20 trucks during the period. The trucks are specified and the supplier does not have the right to use alternative trucks. The customer decides what cargo will be carried, where and when it will be carried to, subject to restrictions specified in the contract, such as the carrying of hazardous material and driving in conflict zones. So those are not allowed. But generally we are allowed to say where and when and what we shall carry. We will not be able, RT, the supplier, will not be able to use them during the currency of the contract. RT operates and maintains the trucks. Commodity trading is prohibited from hiring another company or operating the trucks itself during the contract. So RT Logistics will provide the drivers. Does this contain a lease? In this particular case, we can see it's different from the other one because our right to say the questions that we had posed, the what cargo will be carried, where and when it will be carried from, are not restricted. There is a restriction from hazardous material and driving in conflict zones. But what are those? Those are protective. Any person who gives you the item will give you some sort of, they'll give you some restrictions so that they can protect their assets. So that's why we call those protective. So for instance, it doesn't mean that if you rent a 2-bedroom flat in a complex, then we say that there's no lease because they say there's no pets, or the landlord says that you can't have more than 2 people in this 1-bedroom flat. Those are protective. Otherwise, it would be dangerous for his assets. So that makes sense. So the contract does contain a lease because we have the right to use it for a 3-year period. The assets are identified. Right to control the use is there. We get substantially all of the economic benefit. We'll have exclusive use over the assets over the period. And the customer has the right to direct the use of the asset. In other words, the questions of how and for what and where and when are in our hands as the customer. Therefore, we conclude that we have a lease. What if an agreement contains a lease and non-lease components? What does that mean? You're told pay 10,000 Rand for the use of this forklift per month. That includes use of the forklift, insurance, maintenance. Will come, send someone to fix it if it has any problem. So you're paying for other things. Remember what a lease is. Lease is the payment for the right to use the asset. All the additional things that are included in there. So you rent a building, they tell you it's 100,000 a month, and that includes use of the building, electricity, and water. So what does that mean? So if electricity, water, use of the building are included in the asset, it means you're paying not just for the use of the asset, you're paying for extra stuff. That extra stuff is what we call non-lease components in a contract. So the general rule is that we should be able to allocate the consideration on the basis of standalone price of the lease component and the aggregate standalone price of the non-lease component. So if you're paying 100,000 and that includes utilities, then we need to work out, based on the standalone, if we were not paying for electricity and water, how much would that be? Now, the standard setters are aware that it's not easy. It may not be easy for you to determine the non-lease components. Maybe a really area of judgment because you don't know. You're not in the head of the lessor to be able to determine what is lease and what is non-lease. And therefore, they have what they call a practical expedient, where they say, we are giving you an out. You can be able to split out the lease and the non-lease components, or rather than splitting them out, you can take the 100,000 and account for the full 100,000 together as part of your measurement of the asset and the liability. So that's quite a big practical expedient, as they call it, for people who are applying the standard. So the practical expedient is that a lessee may elect, it's a choice, by class of underlying asset, not to separate the lease from the non-lease components, instead account for them as a single lease component. This practical expedient is not applicable to embedded derivatives in terms of IFRS 9. So you may find that there are instances, what's an embedded derivative, where you rent a property and maybe they say that you're renting a farm, they tell you your rental shall be based on the price of corn because you're using it for corn farming. Then we don't say that, okay, yes, we can say we are not splitting out. In terms of IFRS 9, they say that this is an embedded derivative. We need to account for the derivative that arises. In other words, the financial instrument that arises that is measured against an index that's, in this case, it's the price of corn, needs to be separated separately. So you don't say that, hey, under IFRS 16, we have an out where we can account for it together. So what is the lease term? The lease term is a non-cancelable period. I've already covered this. This is a period for which the lease is enforceable. It begins at commencement date and includes any rent-free periods. So instances where they say, hey, come through, you can rent from 1st of January and we'll give you 2 months rent-free. We say the lease commences at 1 January. We don't say it starts at 1 March because we had rent-free for 2 months. Looking at extensions, where the lessee is reasonable certain to exercise that option, an option to terminate. I covered this earlier. So to determine whether or not you're going to extend the lease or whether or not you're going to terminate the lease, we consider all relevant facts and circumstances that create economic incentive for the lessee to exercise the option. So you ask yourselves questions such as these. Have I made significant leasehold improvements, which, I've spent so much on fittings to this shop, which are of significant benefit in the option period? In other words, for me to extract the full value, instead of just losing my investment, I'm probably going to extend my lease. Or if the costs of relocating are so high, then chances are I'm not going to be relocating anytime soon. Yeah, it's going to be costly to move all my items, my members of staff are used to working here and so on. It will be an inconvenience. So likelihood I'm going to extend. What is the importance of the asset to the lessee's operations? And then what is the conditionality linked to the exercise of the option? So conditions such as, oh, the rental shall increase by 15%, that's really high. Chances are then that we are going to lean towards not extending. So those are the kind of things that we would consider in looking at whether or not we would be extending the lease. Still considering the lease term, we need to consider any residual value guarantees. This is where the lessee guarantees a minimum fixed cash return that is substantially the same regardless of whether the option is exercised. In this case, we need to consider past practice with similar assets. For example, if a lessee typically uses an asset for a period of time, what is our past practice with an asset? With a forklift, for instance, what have we done previously? Have we been extending the leases? Have we been terminating? And so on and so forth. So we've looked at what is a lease. The next part is getting into the actual mechanics. How do we measure an asset and a liability? As we've said, operating leases now will come onto the balance sheet by having an asset and a liability on day one, and how therefore are we going to account for it? So at the commencement date, we end up having an asset and a liability. The asset is the right to use an item, whereas a liability is basically the fact that we've engaged ourselves in obligation. If you look at the definition, we now have an obligation to make payments, and therefore that is why it's called a liability. Let's start with looking at that side first, because I think it's a more complex side and it informs what our asset is going to be. A lessee will recognize a lease liability as the present value of the payments not paid at commencement date. The lease payments are discounted using the interest rate that is implicit in the lease. The implicit rate is the rate that at commencement of the lease discounts the lease payments and the residual value of the assets to equal the fair value of the asset. Now that's very difficult to determine, and if it cannot be determined, we are going to use the incremental borrowing rate. So what are we saying? You enter into a lease for 5 years, you're going to pay 10,000 a month. Obviously, the 10,000 you pay today is 10,000 because of time value of money. It's today. But the 10,000 that you'll pay in 3 years' time is not 10,000, because you've agreed to pay 10,000 in year 3, but that 10,000 is what value of that? Because time value of money, money will lose value, particularly in this country. Therefore, we need to discount it back. We need to use an incremental borrowing rate, and we need to adjust that back, and then we adjust based on our IBR. They say we should use an implicit rate, in other words, the rate that the lessee has built into his lease, because obviously, the lessor is looking in terms of the asset that is giving you the right to use his asset. He's structured the payment such that he doesn't lose out by time value of money. Now that's hard to determine, because then we don't know what the fair value of the asset is and so on. Therefore, if we can't determine that, us as the lessee, then we work out what our incremental borrowing rate is, and we're going to look at that in more detail further along. So the lease payments include fixed payments less any lease incentives receivable. It includes in substance fixed payments. These are payments structured to look like variable payments, and are therefore excluded from lease payments, but are in fact unavailable. So variable payments are not included. So if you're told by other than those that are basically stuff like CPI, it shall vary based on CPI, then those we consider. But if we are told that we are looking at, you'll pay rental for your shop 100,000 plus 10% of all your sales. Now that's a variable payment that's not based on an index. Generally, those are excluded from your calculation. There are also variable payments that you may think are variable payments, but they're not really variable because they are unavoidable. So they're actually fixed. They're going to happen. So there are variable payments where the variable clause has no economic substance. There's more than one set of payments in the lease, but only one is realistic. There's more than one realistic set of payments, but they must pay at least one. Must include the payments that aggregate to the lowest discounted amount. So where they say, okay, fine, you'll pay 100,000, but if for some reason, I don't know, your sales go to a certain point and so on, then you'll pay less than 100,000. And we know in terms of economic substance, then it's likely that that will never happen. So we use the 100,000 as a fixed payment to work out our liability. Also, if there's many sets of payment, then we look at the one that's absolutely unavoidable. It means if our minimum payment is this, then that's the minimum that we're going to use. Lease payments, as I've stated, it includes fixed payments less lease incentives receivable. What are lease incentives? This is where the lessor says, yes, you'll pay 10,000 a month, but I'll write you a check of 20,000 to assist you, to set up your leasehold improvements, or to, set up costs and so on. Then those lease incentives, that they give you, if they tell you, oh, we'll give you 3 months rent back, then we less those. So we're actually looking at what we'll actually pay. Variable lease payments that depend on an index or a rate initially measured using the index or the rate as at the commencement date. So if we are told that we are going to increase our rentals by CPI of, CPI, whatever the rate of CPI is going to be, then we look at that rate, and then we can be able to say, okay, fine, we're going to use this to estimate what our lease payments are going to be. If they're not based on an index such as CPI, interest, market rental rates, and so on, then such as those on future performance, they're not included in the lease payments, but they're expensed as a car. Most common is turnover rental, where they say you'll pay a percentage of your sales as a rental. Then once a percentage is calculated and we need to pay extra, that extra is expensed once it happens. It's not part of our liability on day one. Lease payments include fixed payments less any lease incentives receivable. Variable lease payments that depend on a index or rate initially measured using the index or rate at the commencement date. Amounts expected to be payable by the lessee under the residual values guarantees. In addition, the exercise price of a purchase option if the lessee is reasonably certain to exercise that option, and remember to consider the factors that we described when we're looking around purchase option. In other words, what is the likelihood that you're going to buy the thing? If it's likely, then we include the purchase amount as part of our lease liability. If we know that, no, looking at it, we don't think we are going to buy the place or buy the thing, then we can exclude that purchase option from the lease liability. And finally, payment of penalties. This only makes sense if I think that I'm going to terminate after 3 years. Then I begin to ask myself, is there a penalty that I'm going to pay? If the answer is yes, then my lease term will be based on 3 years, based on my termination, but I also have to include that penalty as a measurement in my lease liability. So if done the liability side, let's look at the asset. Initially, our right of use asset comprises the amount that of the initial measurement of liability. So it's like for like. So our journal entry is to debit the right of use asset and to credit the lease liability for the same amount. Any lease payments that are made at or before the commencement date, less any lease incentives received. So if we paid a certain amount to secure the lease, for instance, that is also debited into the asset. Remember, the liability is measured at the commencement date. So what came before that, we would add to the right of use asset. Less any lease incentives received. If the lessor writes us a check, then we reduce our right of use asset by that. Any initial direct costs incurred by the lessee. This is a change, obviously, from what we've done previously. If there were direct costs that were involved, we had to make some sort of payments, then those are included. And any estimate as per dismantling and removing the underlying asset, restoring the site. So we lease a site in terms of IAS 37. We are told we need to create a provision for dismantling and removing. So on our provision side, we would raise the provision. And then on the debit side, we would debit the right of use asset. Quite different from what we were doing earlier, where we would have ended up having an expense on the debit side. This obligation, as I've said, is measured in terms of IAS 37. So let's look at an example. Angus Limited enters into a 5-year lease agreement for 300 square meters of office space with the option to renew for 3 years. Okay, so we ask ourselves, are we going to renew or are we unlikely to renew? If we are likely, then it will be 8 years. Lease payments are 100,000 per year during the initial term, 110,000 for the optional term. So we'll pay 100 grand every year for the first 5 years, 110 for the 3 years once we renew, and the payments are yearly in advance. To obtain the lease, Angus incurred costs of 20,000 in respect of commission to the letting agent. Remember what we've just said. What happens to that? We would debit that to our right of use asset because it's a direct cost. The landlord gave us an allowance of 60,000 for renovations of the building. What is that? That's a lease incentive. So what does that mean? We're going to, debit bank. We are going to credit our right of use asset. We reduce our right of use asset by that. At the lease commencement date, Angus was not certain that it would exercise the renewal option. The interest rate implicit in the contract is difficult to determine. What does the standard say? If it's difficult to determine, then we are saying that we need to use the incremental borrowing rate, which is what we can currently borrow for loans with a term period of 5 years. Why are we using 5 years? Because as you've seen from the 2 points up, it says we were not certain that we would exercise the renewal option. So if we are not certain, then we say we don't expect to renew, and therefore we use 5 years as the period, and therefore our incremental borrowing rate is what we can currently borrow for loans for a term of 5 years for this type of asset. Basically answered all the questions. Debit the right of use asset with 500,000. Where do we get that? That's 100,000 for the 5 years. Look, we're supposed to discount the 100,000 by the 10%. It's not been done here. That's what we should have done. And we credit the lease liability 400,000, and we credit bank. Why do we credit bank? Because on day one we're going to pay 100,000 because the payments are in advance. Then we debit the right of use asset. Again, we said the initial costs incurred go into the right of use asset, and it's the opposite with lease incentive, where we credit the right of use asset for the amounts that we've banked that the lessor has decided is going to give us. So we're still moving from point A to B. We've looked at the scope exemptions, what is a lease, and initial measurement. Next, we look at what subsequent measurement is, or rather, what are the rules? How do we account for the asset, thereafter, and the liability? Let's start with the liability. A liability is subsequently measured by increasing the amount to reflect the interest on the lease liability. So subsequent to commencement date, as time passes, we shall have interest expense that comes through, because remember, in terms of time value of money, when you discount something, then you build up towards that amount. So you'd have interest that would be increasing, but the payments that we make are going to reduce our liability. So subsequent to commencement date, the lessee will recognize in profit or loss interest on the lease liability, and variable lease payments are not included in the lease liability. Interest is the amount that produces a constant period rate of return on the remaining balance of the lease liability. So liability, increasing the amount by interest and reducing the amount to reflect payments made during the period. Also, remeasurements of the carrying amount to reflect any reassessments, or if you may have modifications to reflect in substance fixed payments. You have situations where midway through the contract you have some adjustments, I don't know, you go and you petition the landlord to reduce the payments and so on, then that is going to be reflected subsequently as a reduction in our liability of what we need to pay going forward. So these are things that we need to consider when reassessments happen. So in other words, when there's changes. So when there's changes to a contract midstream, it's quite important, and there's a nice video from the IASB on this that's on YouTube. You have change in lease terms, change in assessment of the option to purchase. Those are examples. If that happens, then we need to determine the revised lease payments. It could also be change in the amount payable under residual value guarantee, or a change in an index or rate used to determine lease payments. Then it means we have revised lease payments going forward. And we determine the discount rate as the implicit rate over the remainder of the lease, and we adjust the right of use asset. If the asset is 0, then we take it to profit and loss. There may be instances where we keep the same discount rate. We should keep the same discount rate unless the changes result from a variable interest rate change. So that's in the case of block B, the blue one, where we are saying that there's a change in index or rate used to determine the lease payments. So what we're looking at there is modifications, and this is to unpack it a bit better from that diagram. If a lease is modified, the lessee determines the revised lease liability, taking into account the modified lease terms, the revised lease payments, the revised discount rate over the remaining lease term. For adjustments to the lease liability that reduce the scope of the lease, what is a reduction of the scope of the lease? To reduce the scope of the lease is to say that I am going to either lease more staff, or I'm going to lease staff for longer. So that's lease less staff, reducing it, or lease the thing for a shorter period. So the scope of the lease has been reduced. Either the item that we are leasing, we are taking less of it, or the time period, we are taking less of it. In that case, we adjust the right of use asset to reflect a partial or a full termination, and we recognize any gain or loss on termination in profit or loss. If the adjustments to the lease liability increase the scope of the lease, in other words, then we are leasing it for longer, or we are leasing more of the stuff, so we're leasing 2 floors of a building and we decide we're going to take up a third floor of the building at a rate similar to what we're paying for the two, then we adjust the right of use asset because obviously now our scope has increased. That would be the effect. So step one is to recalculate base revised lease term, revised lease payments, revised discount rate once arising from the change. If the change is reducing the scope, then we adjust firstly to reduce our right of use asset, and if there's any gain or loss, that goes to profit or loss. If it increases, then the full adjustment would just be to increase our right of use asset. How do we account for assets then? Subsequently, this is the easier side. Subsequent measurement of the asset, generally the first option and the most common option is to apply IAS 16. In other words, to treat the right of use asset as a property, plant and equipment type of asset. And you'll find that you're going to have this under your property, plant and equipment note, although you're allowed to present it separately. So the initial cost as determined above, in other words, we worked out the lease liability. We've looked at the example of how the asset is initially recognized. In terms of IAS 16, what do? You look at the useful life and depreciate it. You also check impairment by applying IAS 36, and that can definitely happen. You rent a building, the building catches a fire, you're still required to make payments, and you've capitalized this big amount right of use asset. It's not an asset anymore because what's an asset? It's the future economic benefit that's been impaired, and therefore you need to reduce it to the recovering amount, plus any remeasurements of lease liability that may arise. So you might get, some relief from your landlord, which then reduces your lease liability. Note if the lease will transfer ownership or if the cost of the asset reflects that the lessee will exercise a purchase option, then you depreciate over the useful life of the asset because you're going to use the asset for its useful life to you. If the above does not apply, then we look at the shorter of the useful life of the item or the lease term. So you may be leasing an item that its useful life, like a forklift, maybe has a useful life of 7 years, but you only have a 6-year lease of the item. So you can't apply in terms of PPE rules. You can't say, okay, fine, I'm going to use 7 years, which is a useful life to me. You'd apply the lease term, which is the 6-year period. Can you use the revaluation option? Yes, you can. Similar to PPE, you can apply the revaluation model. So you're leasing land, it's a right of use asset. Land is appreciating in value. You have a long-term lease of 30 years. Then, obviously, your value of the right of use is going. So you revalue it at a point in time, and then remember under IAS 16, you revalue the item, and then you still have to depreciate. Well, land you don't depreciate, but if it's an asset that you can depreciate, then you would apply revaluation, but you also need to remember the depreciation requirements of IAS 16. The fair value model, you apply the fair value model in IAS 40 investment property. So if an entity elects to use the fair value model for a right of use asset that meets the definition of an investment property, then it must apply this model to all right of use assets that meet the investment property definition. Okay. So remember the example I gave earlier of a hotel, where we said a hotel can be considered investment property. Why? Because what's the definition of investment property? Definition is it's to earn rentals or for capital appreciation. So most hotel chains do not own the buildings that they run, the Radissons and the Hiltons and so on. Someone else owns the building, they come in, they enter into some rental or management contract and so on, and then now they're using the building as investment property. So they have a right of use asset, maybe they've rented it for 20 years to run a particular Radisson, and therefore they can use it as investment property. They calculate the right of use asset, they use the investment property model. In other words, they keep fair valuing the value of their right of use asset. This is a recent pronouncement that's come through the ISB of subsurface rights in terms of IFRS 16. There's been the question that's been posed to them, and there's been a recent pronouncement, and we'll look at an example. Here is a case study. Remember what we said the scope of leases applies to. The first point was to say leases to explore for or use of minerals, oil, natural gas, and similar non-regenerative resources. So the question is there a situation where you're using an item for something that's similar to oil, natural gas, and so on, but it's actually not the exploration, but it's for use and so on. So you're not really digging into the ground to extract the oil. And that's what we're saying with our case study. What is the definition? What is the definition of a lease? A contract is or contains a lease if it conveys the right to control an identified asset. We need to have the right to obtain substantially all the economic benefits from use of the asset and the right to direct the use of the asset. The assessment is made at inception. We've covered this before. So in terms of our case study, this is a case study where an entity was renting a farm, and what they were doing with the farm is they were using it to lay a pipeline through the farm, a section of the farm. And the question that was posed to the ISB was whether or not we have an identified asset and whether or not we can say that there is a lease. So the first question we ask is whether there's an identified asset. If we're asking ourselves whether then an identified asset, the next question, if the answer is yes, that we have an identified asset, then we can be able to say that we can move to the next question. So remember the requirements to answer the question whether or not there's an identified asset are: an asset can be identified in a contract explicitly or implicitly. It must be physically distinct. An asset is not identified if the supplier has a substantive right to substitute the asset throughout the period. In the example that I've mentioned, then there is an explicit identification. In this particular case, they said we're going to lay a pipeline. It's going to be X number of meters from the fence on the west wing of the farm, and that's where we're going to lay a pipeline. So we explicitly identify what portion of land we are going to lease. So we answered yes to that. The next question we ask ourselves is, does the customer have the right to obtain substantially all of the economic benefits from use of the asset throughout the period? Economic benefits, you save substantially all. You have exclusive use of the asset, you can sublease, and you get the primary and byproduct cash flows. Those are the type of benefits that we would say give you substantially all of the economic benefit. So here is the details of the case study that I was describing. Drill obtained substantially all the benefits in the contract. Throughout they have a 20-year period throughout the exclusive use of the pipe. So through the farm, they've been told they can use it for 20 years. They have exclusive use, obviously, of that portion of land so that they can be able to use the pipe and exclusively use the portion that they are using. So if we answer yes to that, we need to look at the next question. Does the customer, the supplier, or neither party have the right to direct how and for what purpose the asset is used throughout the period? In this case, we ask ourselves, who can direct how and for what purpose the asset is used? We've talked about this. It's the type, the when, the where, and the quantity. If it's a supplier, it's not a lease. If it's a customer, it is a lease. If neither party has the predetermination, then we say we need to look at how and for what purpose if they've been predefined, then it's only the customer who should have the right to operate the asset without the supplier having the right to change those operating instructions. Now, in this particular case, it seems to be predetermined. Why? Let's look at it. The use of the asset is predetermined in the agreement. The drill has the right to operate the asset within the terms of the agreement and make all decisions regarding the use of the pipeline. In other words, they can talk about how much oil they want to pass through the pipeline. They can also perform inspections, maintenance, and repairs of their pipeline. It's theirs for the exclusive use. So they have the right to direct how the asset is used. So this was basically an agenda decision that they had where they're talking about whether or not this can be accounted under IFRS 16. So firstly, they said, yes, it's a subsurface. Remember, subsurface is just beneath the surface. We are looking at whether or not we can be able to use it, and we can determine how to use it. Yes, they're using it for a pipeline, but that does not mean that they're extracting oil. It's not an extractive or an exploratory type of activity. They can as well have used the land for something else. So it was still considered within the scope of IFRS 16. And then we looked at the other questions in terms of our decision tree. Do they identify it? Yes, they identified it. They said exactly where the pipeline will pass. Do we have substantially all of the benefit? Yes, we do. And then, can we direct how the asset is used? What type of oil we're going to pass through there, when, how much, and so on. We can come in, we can be able to inspect the pipe, fix the pipe, do whatever we do. We are the ones with the right to direct the asset. So as I said, the agenda decision there is that the contract is a lease and should be accounted for under IFRS 16. So ladies and gentlemen, we've been going for an hour and 22 minutes by my count. I think we may need a cup of coffee. Therefore, I'm looking at a break, just a body break for 25 minutes. In 25 minutes, we shall resume and carry on with the rest of the presentation. Remember, you can post your questions. I shall respond to them by typing in the background. So 25-minute break, and then we shall continue for the second half of this presentation. Thank you. Okay, ladies and gentlemen, it's time for us to resume the second half of our webinar. We will carry on looking at recent pronouncements that have come around in the past 6 or so months that ISB has been dealing with this standard since its implementation, which happened for year ends beginning on or after 1 January 2019. The next pronouncement we're going to look at is the lessee's incremental borrowing rate. I did promise to look at this in more detail. So at initial measurement, the contract should be is a lease and should be accounted for under IFRS 16. We know at the commencement date, you have an asset and you have a liability. Now, in terms of the liability, we need to measure it using an interest rate. What interest rate do we use? It's either the rate implicit in the lease or we use the incremental borrowing rate, if that is not readily determinable. At initial recognition, a lessee will recognize a lease liability at the present value of the lease payments not paid at commencement date. The lease payments are discounted using, firstly, the interest rate that is implicit in the lease. And this is not a choice that we have. That's the rule that we're supposed to apply. If it's not determinable, then is when we turn to the incremental borrowing rate. So the present value of lease payments plus the present value of any unguaranteed residual should equal the fair value of the leased asset plus the lessor's initial direct costs. Now, what's the problem is that it can be difficult to obtain, especially on long leases, what the present value of unguaranteed residual is. And also, it's not always readily determinable to know what the lessor's initial direct costs are, because we are not the lessor, we are the lessee. Also, the fair value of the leased asset, it would be quite a mission for us to have to always find out what the fair value of the leased asset is. A lessee will recognize a lease liability at the present value of the lease payments not paid at commencement date. The lease payments are first discounted using firstly the interest rate that is implicit in the lease, and if that cannot be readily determined, then we use the incremental borrowing rate. This is not a choice. That's the process that we actually follow. First, try determine the implicit rate in the lease. If you determine that it's not readily determined and you need to document that, then we go and determine what the incremental borrowing rate is. And that's what we're trying to unpack. What exactly is the incremental borrowing rate? This is the rate at which an entity would borrow to acquire the right of use asset. That's not the underlying asset, but the right of use asset. It should reflect the term of the lease. It should reflect the rate of a secured borrowing. It should reflect the credit standing of the entity in a similar economic environment to that of the lease, and exclude any cost of equity finance. Therefore, you cannot use the entity's weighted average cost of capital. Now, that's a very key thing, and it's a question that we repeatedly asked, where I think this is what has been posed to the ISB, where people say that they're going to use their weighted average cost of capital as the amount that they're going to use, as the interest rate that they're used to discount their leases. Now, this is not allowed because incremental borrowing rate is the rate of borrowing. The word borrowing means debt. Now, debt means that the amount that you would pay to get a loan. So think about it this way. If you were to go to get a mortgage bond, even you as an individual or as an entity, what happens when you go and get a mortgage bond? You go to the bank, then the bank will tell you, I need some things from you before I can give you this loan. So they tell you, give me your balance sheet, your income statement, tell me how much you spend, how much you earn, how much you spend, what's your balance sheet look like. And then based on your risk profile, they shall then determine how much they're going to charge you, what the interest rate for the amount is. Now, the interest rate depends on many factors. One, what does your balance sheet look like? Two, what is the state of your income statement? Three, what amount are you borrowing for? What is the period? Is it a 15-year or a 20-year mortgage? What is the asset that you're borrowing for? Is it for, a 5 million rand house in a Gulf estate, or is it a two-bedroom flat in a complex in a densely populated area? Those are two different type of assets. So that is what determines the rate that the bank is going to charge you. So the lessee's incremental borrowing rate is therefore a lease specific rate that the board defined to take into account the terms and conditions of the lease. So time to think. When determining the incremental borrowing rate, should the rate reflect the interest on a loan with both a similar maturity to the lease and similar payment profile to the lease payments? In other words, should they have the same duration, payment profile, security, etc.? The observation of the IASB, that's the International Accounting Standard Board, is that in determining its incremental borrowing rate, the board explained that depending on the nature of the asset and the terms and conditions of the lease, a lessee may be able to refer to a rate that is readily determinable as a starting point. It needs to be the starting point. So this is another question that is posed where people ask, can I use the prime interest rate as my starting point for my incremental borrowing rate? Or can I use the borrowing rate? Can I just say, okay, fine, I know it was slashed recently, what is the prime rate? And say, I can be able to get prime. No, you can't use the prime rate. You need to think like the bank. The bank will not charge everyone the prime rate to borrow. Say you get, or you can't even use a historic rate because you went last year to get a loan from the bank. They told you the interest rate they'd charge you at that point. If you go back for a different asset today, they won't say, oh no, don't worry, sir, we have everything on file, we'll charge you the same. They'll ask for the same information. They'll ask for your assets, your liabilities, your income statement. They'll try and establish what is the period, what's the asset, what's the security, and so on. Then the interest rate they give you may well be the same, but chances are it may be different because things have changed. So that's what we are saying. You can use the prime rate, but it needs to be a starting point for which then you adjust based on other items to say, okay, fine. We would get prime, but we'll not just get prime, we'll get prime plus this because of that, because this our profile goes up, this is a larger amount, this is a period, and so on and so forth. So it's not something that is very easy to just say, okay, fine, we can be able to determine and use the prime rate and weighted average cost of capital we said you can't use. The rate needs to be lease specific. So what did the IFRIC decide? The definition of a lessee's incremental borrowing rate in IFRS 16 does not explicitly require a lessee to determine the IBR to reflect the interest rate in a loan with similar payment profile to the lease payments. However, the committee observed that in applying judgment in determining the IBR, it would be consistent with the board's objective when developing the definition of an IBR for a lease to refer as a starting point to a readily observable rate for a loan with a similar payment profile to that of the lease. So again, it's readily observable, but a similar payment profile to that of the lease and only as a starting point. Let's move on to the definition of a lease. In this case, we are looking at decision-making rights. In this instance, it's a case study where we are seeing a situation where we've got different variables that come up. There's some variables that indicate that an asset is, there are some variables that indicate that the control is with the customer. Other aspects show that the control is with the supplier. So you're left in between, and it's a real judgment call to try and determine how do I determine, because we know if the decision making rights are with the customer, then it's a lease. If they're with the supplier, then it's not a lease. How do we determine that? Okay, let's get into the case study. Miner Limited enters into a contract with Ship Limited, that's the supplier, for the use of a ship for a 5-year period to transport coal to Mauritius. The ship is explicitly specified in the contract. and the supplier does not have substitution rights. The ship is therefore an identified asset as described in IFRS 16. So we've already ticked that box right from the outset. Now, Miner has exclusive use of the ship throughout the 5-year period of use. So again, we can say substantially all the economic benefits from use of the ship. We tick the second part of our decision tree. The questions, therefore, are now based on the third question. In other words, who directs the ship? The ship will be used to transport coal for the customer for the 3 different regions, so from X, Y, and Z, and based on Miner coal purchase agreements with external suppliers in those regions. Miner has agreed to purchase a fixed quantity of coal per year from each region, which cannot be changed throughout the 5-year period. So what does the shipping contract specify? The shipping contract specifies the loading quantity of the ship per voyage, that's the capacity of the ship of 100 tons, a consecutive voyage condition, that's the continuous shipment except for ship inspection and repairs, the 3 types of voyage, that's this, you can start from X to Mauritius, from Y to Mauritius, and Z to Mauritius. So the points of origin have been specified in the contract from these different points, and the destination is always Mauritius. The shipment distance and duration per type of voyage, and the price per ton of coal transported per type of voyage. During the period of use, Miner Limited determines the annual and quarterly shipment plans. Miner has the right to determine the order of voyages throughout the period of use, that is to determine from where the ship sails for each voyage. In doing so, Miner is required to adhere to the terms of the shipping contract that requires continuous shipment of 100 tons of coal during the period of use. Ship Limited operates and maintains the ship and is responsible for the safe passage of cargo on board the ship. For example, the supplier has a right not to sail in war risk areas. Miner is prohibited from hiring another operator for the ship during the period of use. Note that Miner did not design the ship or any specific aspects of it. So we've said that we tick the first box, identified asset, substantially all of the economic benefits. The question we're asking is, who has the right to direct how and for what purpose the ship is used? Remember, if it's clear-cut that it's a customer, we go down to the green box, it's a lease. If it's a supplier, then we go down to the red box, we say it's not a lease. If it's neither, because it's been predetermined in the contract, then we move on to the next question, that would be question number 4. So we've covered this. What happens when not all the decisions around how and for what purpose an asset is used are predetermined? So the questions we've covered, we said you look at the where, the what, the when, the who, the how, the why. Those are the questions that you ask yourself to determine who is the decision maker when it comes to the use of the asset. So as we've said, if it was predetermined, then we would have moved to paragraph B24b, that's the next question. But if it's not predetermined, then we are stuck in question number 3, where we need to make a call between the customer and the supplier. Because not all the relevant decisions about how and what purpose the ship is used are predetermined. Therefore, we don't go to B24b, we go back up to B24a. So B24A, this is from the standard, specifies that a customer has the right to direct the use of an identified asset throughout the period if he has the right to direct how and for what purpose the asset is used throughout the period. Now, to have the right to direct how and for what purpose the asset is used within the scope of its right of use is defined in the contract. The customer must be able to change how and for what purpose the asset is used throughout the period. In assessing whether that is the case, an entity considers rights to make decisions during the period of use that are most relevant to changing how and for what purpose the asset is used during that period. So you're looking for relevance now. Decision-making rights are relevant if they affect the economic benefits. So it's a question of, fine, the supplier has some decisions that he can make. I, as a customer, have decisions that I can make. The questions that we're asking ourselves is, which of those decisions that are being made affect the economic benefits that arise from the contract? So examples of who has the decision-making rights include, changing the type of output, when, where, and quantity of output. We've already covered that. Rights limited to operating or maintaining the asset do not grant the right to change how and for what purpose it is used. Now, an entity only considers decisions that are predetermined before the period of use when assessing if the asset was designed in such a way that it was predetermined the how and for what of use. In other words, that is if we were to be able to move to the next box, question number 4, that's B24B. So in analyzing the case study, miner has the right to make decisions about the use of the ship during the period of use that affect the economic benefits to be derived from that use. Within the scope of its right of use defined in the contract, miner can change how and for what purpose the ship is used. Where decisions were predetermined, these define the scope of the customer's right of use. It is within that scope the customer has the right to make the decisions that are most relevant to changing how and for what purpose the ship is used. So note that operation and maintenance, clearly those are not essential. They do give Shipping Limited a right to direct how and for what purpose the ship is used, as well as the fact that they're operating it. They can choose what route they'll use if they're going from X to Mauritius. I don't know how it is in shipping, maybe there's shortcuts or things like that. They can make that decision, but those are not the decisions that are impacting the economic benefits. Decisions impacting economic benefits are definitely when you're looking at, the amounts that are going to be shipped and so on and so forth. So we tick the box, the customer has the right to direct how and for what purpose the asset is used, and therefore we move down to the green box and conclude that it is a lease. Let's look at another question that's been posed to the IFB, that's the IFRIC, the International Financial Reporting Standards Interpretations Committee. This is in terms of the lease term and useful life of leasehold improvements. We've already covered what a lease term is, so I'm not going to repeat that. I'll just get straight into the analysis of the case studies that we have at hand. IFRS 16, we've said that the lessee needs to look at the period that is enforceable. Now, if you look at the definition of what is enforceable in terms of B34, a lease is no longer enforceable if the lessee and the lessor each has the right to terminate the lease without permission from the other party, with no more than an insignificant penalty. So IASB's view in this case is to say that we need to look at the reasonable expectation of the period during which the underlying asset will be used, because that approach provides the most useful information. So the case studies we are going to look at, I can just, I can preempt what I'm going to cover. The question that is posed to them is this. Imagine you're in a month-to-month lease, and I think a number of you have encountered this. I keep getting asked this question whenever we're delivering training or doing an IFRS 16 implementation project. People normally say, I'm in a month-to-month lease. So does that mean because in a month-to-month, the lessor can kick me out with a month's notice, or we have a lease that has a 3 months cancellation? Should we say therefore that the lease only has an enforceable period of 1 month, or an enforceable period of 3 months, and therefore there's no need for us to apply IFRS 16. We can easily slip into the exemption of the 12-month exemption, and therefore we do not need to apply IFRS 16. Now, what ISB is saying in terms of this IFRIC, or rather the agenda decision here, is to say, look at the reasonable expectation. So for instance, you have a lease that's a 5-year lease, and after 5 years it goes on month to month. You spent so much money renovating the place, putting in leasehold improvements. It is something that is important to your business. You know, relocating from there is going to be quite expensive. Your employees, would have to travel far if you had to go and move from wherever you are to a different point. So chances are that you're going to stay for another 5 years when that 5 years expires. So whether or not the fact that even though the contract says it's month to month after the end of 5 years, you know that I'm going to spend another 2 years, 3 years, 5 years there. So use the reasonable expectation. It means that your leasing period goes beyond that 5 years. The same thing applies if you're looking at termination as well. Don't just look at the contract, look at the economics of the contract. In other words, look at economic substance, not just legal form. So, as I've just mentioned, look at the broader economics of the contract and not just the contract termination payment period. If there's an insignificant penalty, well, this is just basically saying exactly what I said in the previous slide. Same thing, but now with regards to termination, they're the same considerations that you need to look. Don't just look at what the contract says. Use the reasonable expectation of the time period that you're going to be in the lease. Will the lease term be extended? The factors to look at, terms of the optional period. If the optional period for extension says 15%, it's going to be way expensive, so you know you're not going to extend. Do you have significant leasehold improvements? What is the importance of the asset to your operations? And other conditions that affect the likelihood that you're going to extend the lease and whether or not those conditions are going to exist. So case study 1, I've mentioned this one. Lessee A enters into a lease, and in this lease, it continues indefinitely with 3 months notice. Don't just say, okay, fine, 3 months notice, then 3 months is my lease period. Despite that there is no penalty, look at the reasonable expectation. Scenario 2, similar. This is a month-to-month lease. It's initially 12 months and then month-to-month. You can't say that, it's month to month, so let me use a month as my lease period. Reasonable expectation based on economics. Scenario 3, it continues indefinitely until either party gives 6 months notice. Should X cancel within the first 5 years, there's a penalty of 2 million to pay. The monthly lease payments are 100,000. That's a huge penalty of 2 million to pay if you cancel within the 5 years. So already the economics are telling you that the likelihood of you cancelling are not 5 years. So this lease, we would say, is a minimum of the first 5 years. Scenario 4, a lease that you've entered into for 12 months, you can cancel with 30 days notice. You spent 3 million outfitting the office space, yet the lease payments are 1.2, it's 100,000 a month, so it's 1.2 per year. You spent a whopping 3 million. Someone who spent a whopping 3 million on a lease is not going to abandon that lease very fast, despite it being a 30 days notice period. So reasonable expectation. The economics of this case study suggests that you're going to stay for a longer period. So how does asset accounting impact on the above? Asset accounting under IAS 16, we've already covered this generally. Think about it. If you have leasehold improvements that you've put in, PPA, the IAS 16 is basically saying you need to consider not just the useful life, you need to look at the useful life or the legal limits that may exist, and legal limits would include the lease term. So you may have shelving that you put in premises. You know the useful life of those shelves for you is 7 years, but you know after 5 years you're going to be leaving the place. So you don't depreciate the asset of our 7-year useful life period. If they are non-removable leasehold improvements, then you're limited to the 5-year lease term. And that's what I've basically explained in the previous slide. So when assessing whether a lessee is reasonably certain to extend a lease, IFRS 16 requires an entity to consider all relevant facts and circumstances. So they're speaking the same language as we were speaking in IFRS 16. This includes where significant leasehold improvements have been undertaken that are expected to have significant economic benefit for the lessee when an option to extend or terminate the lease becomes exercisable. Remember, an entity considers the broader economics of the lease. So So we've talked about that. Cost of abandoning or dismantling and removable leasehold improvements. If it's expensive, then chances are you're going to stay. If you expect the leasehold improvements beyond the date on which the contract can be terminated, the existence of those improvements indicates that the entity might incur more than a significant penalty if it terminates the lease. This would indicate that a contract is enforceable for at least the period of expected utility of the leasehold improvements. We're going to look at the interaction between IFRS 16 and the other standards. IAS 36, we've already mentioned this before, that we need to look at impairment of right of use assets. So if you have a right of use asset, you're renting a shopping mall, for some reason there's some commotion or some wartime activity or some political upheaval and so on that makes you unable to extract the full economic benefit, then you apply IAS 36, you look at your recoverable amount versus your carrying amount, and an impairment is recognized. IFRS 3, there's an interaction with IFRS 3. IFRS 3 says if you buy a company, the company has an operating lease, it has assets and liabilities. The general rule is that you're supposed to bring in assets and liabilities at their fair value. There's an exception for leases. If one entity acquires another entity that is a lessee, recognize the lease liability based on the present value of the remaining lease payments as if the acquired lease were a new lease at acquisition date. The lease term and the discount rate may differ from that used by the acquiree based on its initial assessment done at lease inception. Now, impact in assessing whether a business has been acquired. The right of use asset is equals to identifiable assets. That's included in the concentration test. Concentration test is basically under IFRS 3, they've introduced a concentration test to say, okay, I've bought a block of flats and I'm calling it a business combination. You're supposed to do a concentration test to see whether or not it's really a business that you've acquired. And what IFRS 3 is saying is that if the value of my purchase price is concentrated on the value of one asset, in this case the entire block of flats, then it suggests I've not really bought a business. What I've bought is one asset or a bunch of assets. So it's not an IFRS 3 business combination. It is the purchase of an asset which would then be accounted for either under IAS 40 or whatever standard is relevant. In this case, a block of flats would be IAS 40 investment property, but it could apply to other items, items of PPE, or if you buy a pharmaceutical company and all you're interested is in the formula, then you're actually buying an intangible asset. It may not necessarily be a business. Financial instruments, IFRS 9, lease liabilities are financial instruments, but they're outside the scope of IFRS 7 and IFRS 9. There are parts of the standard that are applicable, that if there's derecognition hedging and embedded derivatives in leases, you still account for them under IFRS 9 rules. Tax is an interesting one. Jurisdiction dependent tax treatment of leases is not always the same as accounting treatment, so they can give rise to a deferred tax position. Two principal approaches for accounting for leases. One is that you consider the lease as a single transaction in which the asset and liability are integrally linked, so there is no net temporary difference at inception. Or you can consider the asset and liability separately, in which case there will be a temporary difference on initial recognition, which will be subject to the initial recognition exemption. Now, the approach would be an accounting policy choice, which would be applied consistently. Other standards, IAS 37, we've mentioned you can have asset retirement obligations, which you would need to bring in terms of your lease. IFRS 8 has some disclosures of assets, liabilities, geographical disclosures, and so on, which then impact the assets and liabilities you have under leases. And IAS 21, if you have a foreign lease, then there are consequences. Your right of use asset is similar to an IAS 16 asset, which means the historical rate would be applicable to it, whereas obviously the lease liability is monetary because you're making payments every month. So your interest and your payments are going to be charged at the spot rate. So there'll be changes in forex rates which will give rise to gains and losses in your profit and loss statement. So we've covered a lot. Let's look briefly at lessor accounting, presentation and disclosure, and then we'll see if we have some time to look at modifications. In terms of lessor accounting, it hasn't changed from IS 17. The lessor still has a finance lease and operating lease. A lease is either one of those two. You'll recall if it's a finance lease, what does that mean? A finance lease means that the lessor has actually sold the asset and then he needs to recognize the gross investment in the lease. In other words, a lease receivable is sold the asset and therefore his asset is now replaced by a receivable where the person is paying off the asset over a period of time. If it's an operating lease, the significant risks and rewards have not flowed to the lessee, in which case we are saying you continue to recognize the assets and the payment that the lessee is making to you are therefore their actual income, they're recognized in income as they accrue. So every time you invoice, then it's lease income that comes through, but the asset remains yours. Classification is based on assessment of if the lease transfers substantially all risks and rewards. So there are primary indicators that are given. These are indicators that you have a finance lease, if at the end it transfers ownership, or if there's a bargain purchase option, if the lease term is equal to the economic life of the asset, if the present value of minimum lease payments is equal to the fair value of the asset, or if it's a highly specialized asset. Those are suggestions, indicators that suggest you have a finance lease. The secondary indicators as well that have been brought forward from IS 17. In other words, there's a second term that's below market rates. Lessee bears the lessor's losses, and the lessee has the residual risk. Those all suggest that the risks and rewards have flown to the lessee, in which case you would have a finance lease, and the opposite would be true. Next, we look at presentation and disclosure. So statement of financial position, you need to present the right of use asset separate from other assets or include it in the same line as similarly owned assets such as PPE with separate disclosure in your note. Investment property right of use assets are always disclosed as investment property. And for lease liabilities, again, separate from other liabilities, or if you include them in similar liabilities, like finance lease liabilities or stuff like that, then you need to show in your notes them separately. So there's a lot of IFRS 16 disclosure requirements that you need to pay attention to. They are detailed in the standard. Statement of profit and loss, you need to present the interest and depreciation separately. And remember, you might also have an impairment line item. Now, if it's an operating lease where the exemption doesn't apply, therefore, where the exemption doesn't apply, it means that your rental expense is now replaced by interest and depreciation. Disclosure in the notes. Disclosure objective is to provide users with the basis to assess the effect that leases have on financial position, performance, and cash flows of the lease. There are numerous qualitative and quantitative disclosures that are required. When is it effective? You probably know this. Year ends on or after 1 January 2019. So a lot of you might be busy with implementation projects. Early adoption, probably that has already shipped, or rather that we've already got past that. If you've done it already, if you haven't done it, the option is available. If you had adopted IFRS 15 earlier as well, then you could have done IFRS 16. Now IFRS 16 periods beginning on or after 1 January 2019. Remember, it's an area that we can assist you with. Items such as incremental borrowing rates, which, as we've said earlier, the principles make it something that needs, someone with corporate finance experience to determine. Would be able to assist you with that, or with the calculations, or with assessment of leases as to whether they are leases or not, and the applicable variable and fixed areas. Would be happy to assist if you require assistance with your implementation of IFRS 16. So we've generally covered everything up until that point. So having covered basically the content that we had from in terms of what we laid out at the beginning, in terms of basically the navigation, starting from the scope, getting into initial measurement, subsequent measurement, lessor accounting, presentation and disclosure, and the recent IASB decisions. The next thing that we need to look at now is basically modifications. And in this regard, we have a presentation from the IASB, which you can stand by and listen to. In the meantime, we can take your questions in the chat box. You're welcome to post them.
Hello and welcome to this webcast on IFRS 16. I'm Patrina Buchanan and I'm joined today by my colleague Catherine Dunkersley. So this is the sixth in a series of webcasts following publication of the new Leases standard, and today we'll be talking about the requirements relating to lease modifications for lessees in IFRS 16. Just to note before we start that, as always, the views presented in this webcast are those of myself and Catherine and don't necessarily represent the views of the board or the IFRS Foundation. So we'll start by briefly explaining the purpose of this session, because lease modifications wasn't a topic that was originally included in our webcast series. So Catherine, why have we decided to do a webcast on this topic, and what can listeners expect to get out of it?
Well, essentially, we've included this topic because we've heard some questions from those working on implementation of IFRS 16. On the face of it, modifications is a topic that only really becomes relevant after the new standard is adopted. However, companies, software providers and other organisations that are working on IFRS 16 are keen to get their systems ready for all potential lease modifications before IFRS 16 becomes effective. So whilst any questions coming up relating to modifications might seem relatively low on the priority list, organisations are keen to resolve these now. So in this webcast, listeners can expect to hear a summary of the modification requirements for lessees, and then we'll be discussing the implementation questions that we've heard so far. Modifications is something of a detailed topic, so we'll include examples as we talk it through. We'll also summarise key takeaway points from those examples at the end of the session. For the avoidance of doubt, everything we're talking about in today's webcast relates to lessee accounting. That's because all of the questions we've heard about modifications relate to lessees and not to lessors. It's probably also worth noting that this webcast assumes listeners are already familiar with the lessee measurement requirements in IFRS 16. If that's not the case, then it would be a good idea to listen to the measurement webcast before listening to this one.
So first, a summary of the requirements in IFRS 16 relating to lease modifications for lessees. As this slide shows, there are three different ways that a lessee might account for a modification. The accounting treatment depends firstly on whether the modification in substance represents a separate new lease. If it does, then the lessee accounts for that separate new lease as it would any other new lease. If the modification does not represent a separate new lease, then a lessee needs to assess whether the modification decreases the scope of the existing lease. The accounting treatment differs because if there is a decrease in scope, then a lessee will need to think about any gain or loss arising on the element of the existing lease that has been terminated. and we'll talk in a bit more detail about each of these scenarios in turn. So first, let's look at modifications that are accounted for as a separate new lease. IFRS 16 includes two criteria to account for a modification as a separate new lease, and both of them must be met. First, the lease modification must increase the scope of the lease by adding an additional right of use that wasn't there before. This could arise if, for example, a lease of property is modified to include an additional floor of a building. Second, the consideration for the lease must increase by an amount that is commensurate with the standalone price for the increase in scope and any appropriate adjustments to reflect the circumstances of the particular contract. So, for example, in a lease of property that is modified to include an additional floor, does the consideration for the modified lease increase by a similar amount to that which would have been agreed for a new standalone lease of the added floor, taking into account, for example, that the lessor might give some discount because he does not have to incur marketing costs to lease that floor to a new lessee? If consideration does increase by an amount commensurate with the standalone price, then the modification is in substance a new lease for that one floor. In that case, the lessee accounts for the modification exactly as it would a separate new lease of one floor of the building. When this accounting applies, there is then no special modification requirement because the lessee just applies the normal IFRS 16 requirements for a new lease. There is also no change to the accounting for the original lease. So let's move on then to the other lease modifications, those for which the modification does not represent a separate new lease, but instead is a change to the existing lease. There are two scenarios here, but in all cases, the lessee is required to calculate the lease liability for the modified lease. This is the lease liability that will be on the balance sheet after all modification accounting has been performed. The lessee determines this liability by applying a very similar approach to that used at commencement of a new lease. So the lessee does this by allocating contract consideration, determining the lease term, and discounting the revised lease payments at an appropriate discount rate. We talked about these areas during the measurement webcast, and we'll look at some modification-specific examples of establishing discount rates in a later slide. So having calculated the modified lease liability, the lessee then needs to work out the accounting entries, and these depend upon whether the modification decreases the scope of the lease.
Let's first look at the simpler of the two scenarios, a modification which does not decrease the scope of the existing lease. Essentially, this means that the right-of-use assets and lease liability that were on the balance sheet before the modification took place are still there. No element of the existing lease has been terminated. Instead, the lease has been added to or otherwise amended. This might be, for example, a change in consideration for the lease or an increase in scope without a commensurate increase in consideration. So, for example, adding some additional floor space to a property lease for which the additional consideration is less than would have been the case in a new standalone lease of the added space. In these cases, the lessee adjusts the lease liability to reflect the remeasured amounts that we talked about on the previous slide. The other side of the accounting entry goes to the existing right-of-use assets, i.e. debit right-of-use assets, credit lease liability. In this case, the debit to the existing right-of-use asset represents a change in the cost of the right-of-use, or it represents an increase in the cost of the right-of-use if the modification increases the scope of the lease. This is similar to the way that at commencement of a new lease, the measurement of the lease liability is used as the starting point to measure the cost of the right-of-use asset. In the case of a modification, the measurement of the modified lease liability is used to measure the modified cost of the right-of-use asset. The other alternative is if there has been a decrease in scope of the existing lease. This will be the case if some element of the right-of-use asset and lease liability that were on the lessee's balance sheet immediately before the modification is terminated as a result of the modification. Examples include a reduction in lease term or a reduction in the lessee's rights of use, such as less floor space in a property lease. In these cases, there has effectively been a termination of some or all of the pre-modification lease. Therefore, the lessee needs to recognise this termination and any gain or loss on termination. To do this, the lessee must work out what element of the pre-modification right-of-use asset and lease liability have been terminated. There are some relevant examples in the IFRS 16 illustrative examples. For example, in the case of a reduction in square metres in a property lease, the lessee might work out the proportionate reduction in space and apply that to the pre-modification right-of-use asset and lease liability. The lessee then deducts the relevant amounts from both the right-of-use asset and lease liability, with any difference being recognised as a gain or loss on partial termination of the existing lease. Now, it's important to remember that quite often there will be both a decrease in scope of the existing lease and another element to the lease modification that is not part of the termination. For example, it could be the case that as well as terminating a portion of the existing lease, there has also been a change in consideration for the element of the lease that remains. When this happens, then after reflecting the partial termination, the lessee must also make a further adjustment to the lease liability to arrive at the modified lease liability that we talked about on slide 6. The other side of this adjustment reflects a change in the cost of the remaining right-of-use asset, similar to what we discussed on slide 7.
So to summarise, when a modification decreases the scope of an existing lease, the lessee first recognises that decrease in scope by reducing the pre-modification right-of-use asset and lease liability and recognising any gain or loss in P&L. The lessee then recognises any other element of the lease modification, such as a change in consideration for the remaining lease, by making corresponding adjustments to the right-of-use asset and lease liability.
Yes, that's right. And again, just to note that there are detailed examples on this in the IFRS 16 illustrative examples.
Now let's move on to looking at the implementation questions that we've heard to date. Modifications are most easily discussed by way of example. So what we'll do in this section is put some examples up on the slides and talk through the particular elements that have given rise to questions. So firstly, let's look at some questions we've heard that relate to the effective date of lease modifications. IFRS 16 defines this date as the date that both parties agree to a modification. So in practice, often the date that the modified contract is signed. Paragraph 45 of IFRS 16 is clear that in all cases, other than those accounted for as a separate new lease, the measurement of the modified lease liability takes place at the effective date of the modification. That includes, for example, establishing an appropriate discount rate. The reason IFRS 16 requires this to be done at the effective date of the modification is because it is the facts and circumstances at that date that the lessee and lessor would have had in mind when negotiating the modified contract. The questions in this area essentially relate to when a lessee recognises the modified lease liability and the associated modification to the right-of-use asset. There are 3 scenarios here, and we'll look at an example of each. First, a modification that decreases the scope of a lease. Second, a modification that increases the scope of the lease other than by increasing the lease term, so by adding the right to use one or more underlying assets. And third, a modification that increases the lease term. Let's look at some examples of each of these scenarios. So first, we have a modification that decreases the scope of a lease, but for which the effective date of the modification is before the decrease takes effect. So let's say you have a 10-year lease of 2 floors of a building. At the end of year 4, you agree to modify the lease so that for years 6 to 10, you lease only 1 floor. In other words, at the end of year 5, you will give back 1 floor to the lessor. The modified contract is signed at the end of year 4, but the second floor is not returned to the lessor until the end of year 5. Now, in this case, the lessee recognises the lease modification on its balance sheet at the effective date of the modification, so at the end of year 4. This means that the lessee will reduce the lease liability and the right of use asset at the end of year 4, and it will also recognise any gain or loss arising on the partial termination of the original lease at the end of year 4. The questions that have arisen in this area are in understanding why the lessee accounts for the modification at the effective date of the modification. In our example, the effective date of the modification is a year before the second floor will be returned to the lessor. So why account for any gain or loss arising at the earlier date? Catherine, can you clarify?
Yes. So, as you said, in this case, both measurement and recognition of the modified lease occur at the effective date of the modification. That's because as soon as the modified contract is signed, both parties have contractually agreed that the lessee will pay less lease payments than under the original contract. Effectively, this means that from the effective date of the modification, all of the following have been reduced. First, the lessee's obligation to make lease payments. Second, the lessee's rights with respect to use of the underlying asset. And finally, the cost of the lessee's right of use.
Okay, that makes sense. I think, though, that the element that some might find difficult to understand is that the portion of the asset that will be given back to the lessor, so in our example, the second floor, is still in the possession of the lessee and under the lessee's control until it is returned to the lessor. Some have said that accounting for this reduced right of use at the effective date of the modification appears inconsistent with the general model that says a lessee recognises lease assets and liabilities at the commencement of the lease. That's the case even if the contract is signed by both parties at an earlier date. So can you share your thoughts on that?
Yes, so a couple of thoughts here. Thinking about the beginning of a new lease, it is of course correct that right of use assets and lease liabilities are not recognised by a lessee until the underlying asset has been made available for the lessee's use. However, it's important to remember that a lessee only ever recognises an asset that reflects its rights to use the underlying asset. It doesn't recognise the underlying asset itself. So say a lessee leases an asset with a fair value of 1 million for half of its useful life. It doesn't recognise the 1 million on its balance sheet because it doesn't have rights to use the asset for the whole of its useful life. Instead, it would recognise something less than 1 million because it has rights to use the asset for only half of its useful life. Even though the lessee receives the entire asset on day one of the lease, it never recognises that element that must be returned to the lessor at the end of the lease. This principle is exactly the same when talking about a modification that decreases the scope of the lease. As soon as both parties have contractually agreed that the underlying asset or part of the underlying asset will be returned to the lessor early, then the lessee's rights with respect to the underlying asset have reduced. Therefore, it is correct and consistent with the rest of the standard that the modification is recognised on the date of that contractual agreement. This reflects the reduction in the lessee's rights and corresponding obligations.
Okay, next let's look at a modification that increases the scope of the lease. An example fact pattern is on this slide. In this case, again, we have a 10-year lease of 2 floors of a building with a modification agreed at the end of year 4. This time, however, the modification adds a 3rd floor to the lease for years 6 to 10. The modified contract is signed at the end of year 4, but the lessee gets access to the additional floor only at the end of year 5. Now, applying paragraph 45 of IFRS 16, the lessee again calculates the modified lease liability at the effective date of the lease modification, so at the end of year 4. That means, for example, that the lessee uses the relevant discount rates at that date. The difference in this example, however, is that the lessee recognises the modified lease liability and right of use asset on the balance sheet only when the additional floor is available for its use, so at the end of year 5. In other words, measuring these amounts occurs based on the negotiation that took place at the effective date of the modification, but recognition occurs at commencement, when the additional asset is available to the lessee. Catherine, any comments for those who have raised questions here?
Yes, just to explain a little, this recognition approach essentially reflects a difference between a decrease and an increase in scope. As I mentioned on the previous slide, with a decrease in scope, even though the lessee physically possesses a whole asset, if it gives up some of its rights with respect to using that asset, then the reduction in the right of use asset and lease liability needs to take place as soon as those rights are surrendered. With an increase in scope, it is only when the increased asset is delivered by the lessor that the increased right of use asset and lease liability are reflected. This is the same as initially recognising the right of use asset and lease liability at the beginning of a lease, only when the lessor has made the right of use asset available. So, to reiterate, and in answer to the question on the slide, in this case, the lessee recognises the additional 3rd floor on its balance sheet when it is made available to the lessee, i.e. at the end of year 5.
Okay, so moving on then. The third example we'll look at covers a modification that increases the lease term. This time, we have a 5-year lease of a property with a modification agreed at the end of year 4. That modification increases the lease term for a further 5 years, so to 10 years in total. Now, the first question we've heard here is whether an increase in lease term satisfies the criteria to be accounted for as a separate new lease. And in short, no, it doesn't. Referring back to the requirements that we discussed earlier in paragraph 44 of the standard, an increase in lease term does not add the right to use any new or additional underlying asset to the contract. The underlying asset is unchanged. Therefore, a lessee does not account for this modification as a separate new lease.
No, it's not accounted for as a separate new lease. So in terms of what is done here, the lessee first needs to identify the effective date of the modification, which again is at the end of year 4. Consistent with paragraph 45 of IFRS 16, the lessee therefore measures the modified lease liability at the end of year 4. The lessee then moves on to think about when the extended lease term should be recognised on the balance sheet. This is a good example because it really clarifies some of the principles that we've talked about on the last couple of slides. With an increase in lease term, as opposed to adding the right to use new underlying assets, then as soon as the modification is agreed, the lessee already has possession of the underlying assets over which it has agreed additional rights of use. and therefore the lessee recognises those additional rights of use, along with the modified lease liability, on its balance sheet as soon as they have been agreed. So, in this case, the modification is both recognised and measured at the end of year 4.
So the next topic we've heard questions on is discount rate. IFRS 16 is clear that when calculating the modified lease liability, a lessee uses a modified discount rate. This would be either the rate implicit in the lease for the remainder of the lease term at the point of the modification, or if that's not readily determinable, then the lessee's incremental borrowing rate at the effective date of the modification. However, we've heard some questions relating to the illustrative examples in IFRS 16. In particular, some have noted that there are places in the modification examples where the original discount rate is used. In particular, in illustrative example 18. This example relates to a modification that both increases and decreases the scope of a lease. So this is a detailed example, and the key facts are summarised on this slide. The lessee initially has a 10-year lease of 2,000 square metres of space, with annual lease payments of $100,000. Halfway through the lease, at the end of year 5, the lease is modified to add another 1,500 square metres of space to reduce the total lease term from 10 years to 8 years, and finally to increase the annual lease payments to $150,000. Now this is a fairly complicated example, and a helpful starting point in these kinds of cases is to identify the different things going on within the modification so that each one can be thought about individually. First, there is a decrease in scope. So this relates to the fact that originally the lease was for 10 years and the modification reduces it to 8 years. So whatever else is going on, the lessee needs to recognise a partial termination relating to that reduction in lease term. Second, and separate from the reduction in lease term, there has been an increase in the size of the remaining right of use asset. Originally, the lessee had rights over 2,000 square metres of space, but after the modification, it has an additional 1,500 square metres. What a lessee essentially has to do here is think about those two elements of the modification separately.
So first, thinking about the decrease in scope. Now, applying the modification requirements in IFRS 16, all the lessee is doing here is recognising a partial termination of the original lease. In other words, it needs to remove from its balance sheet that element of the right of use asset and lease liability that has been disposed of. For the right of use asset, at the point of the modification, the lessee is giving up 2 years of the remaining 5-year term of the original lease. Therefore, the example illustrates that the right of use asset disposed of is 2/5 of the right of use asset that appears on the balance sheet immediately before the modification. For the lease liability, the lessee must also work out how much of the lease liability on the balance sheet immediately before the modification relates to the final 2 years of the original lease. At commencement of the lease liability was calculated using the original discount rate, and therefore it is that same original discount rate that needs to be used in determining what to remove from the balance sheet. That's why the example talks about using the original discount rates. Having worked out the amount of the right of use asset and lease liability representing rights and obligations that have been terminated, the lessee then recognises any difference between the two as a gain or loss on termination in P&L. After recognising the partial termination, the lessee then looks at the modified lease liability, i.e. the present value of the future lease payments under the modified lease. This modified lease liability effectively includes the increase in scope relating to the new space that the lessee will have the right to use. The lessee calculates the lease liability and corresponding adjustment to the right of use assets using the modified rates, i.e. the rate that applies at the effective date of the modification.
So to summarise then, the original discount rate is used only when working out what needs to come off the balance sheet in a partial termination. The modified discount rate is used when measuring any other modifications, such as changes in consideration or increases in scope.
Yes, that's exactly it. You can also see on the slide the relevant paragraph numbers of IFRS 16 that relate to these scenarios.
Great. So we've talked through a number of examples that highlight the various implementation questions that we've been hearing. So it's probably worth summarising the key takeaways from those examples.
Sure, and these are summarised on this slide. First, in all cases for which a modification is not accounted for as a separate new lease, a lessee measures the modified lease liability at the effective date of the modification, i.e. the date that both parties agree to the modification. This is the case even if there is then a delay before any practical modification to the right of use takes place. If there is such a delay, the lessee needs to think about whether it has already got access to the modified right of use asset. If it has, then it also recognises the modification on its balance sheet from the effective date of the modification. If the modified right of use asset is not available to the lessee at the effective date of the modification, then, consistent with recognition at commencement of a lease, the lessee recognises the modification when the asset is available for its use. Second, we've seen an example of a modification with multiple elements. In these kinds of scenarios, it is helpful to identify each separate element of the modification and deal with it separately. So, for example, calculate the gain or loss on a decrease in scope relating to a reduced lease term, and then work out the effect of an increased scope of the right of use asset. Illustrative example 18 of IFRS 16 covers this in detail. Third, remember that when calculating the effects of a lease modification, it's generally necessary to use the modified discount rate, i.e. the discount rate at the effective date of the modification. The exception to this is if there is a partial termination, i.e. some of the right of use assets and lease liability that were originally on the balance sheet are being removed. In this case, a lessee uses the original discount rate when working out that element of the pre-modification lease liability that needs to be removed from the balance sheet. Finally, just to highlight that there are 5 detailed illustrative examples in IFRS 16 that cover all of the different modification scenarios. Separate new leases, increases in scope, decreases in scope, multiple element modifications, and changes in consideration. These examples are likely to be useful in applying the IFRS 16 requirements on lease modifications.
Thank you. So this final
Well, that then concludes our presentation today, our webcast on IFRS 16. Thank you for having joined us, and it will be communicated to you. There'll be a questionnaire that would be needed to be completed in order to earn your CPD for this particular session. Thank you very much. Our contact details are available to you. You're welcome to contact us if you require anything in terms of any assistance, may it be further training, consulting, and so on. And those are our contact details. Our landline number is still working even now during the the work from home lockdown period, and our email address is also available to you there.